Welcome everyone. In this video here, I'm going to be overviewing the 8 key elements that go into high probability trading. And if you don't know who I am, or maybe this is the first time you ever came across one of my videos, I go by GK the Trader, and I've actually been live streaming for the past 3 years, every single one of my trades to all my viewers, and accumulated a very respectable amount of money as a result of trading these markets. And this here definitely will be one of the more valuable videos that you've ever watched for day trading. And I say that because if you're ever feeling uncertain at the charts at the moment, or you just don't feel uncomfortable, you go back to this video, you watch it, you ask yourselves, are these 8 elements manifesting in the charts right now? If not, guess what? You're not taking a trade. If they are, you should probably be trading it. So let's get straight into it. All right, everyone. Element number 1 of 8 to a high probability trading setup is going to be your higher time frame key level. I can't stress how important this is. This is the first thing that I do and you should be doing as soon as you get onto the charts. All high probability setups start here. You find your daily levels or weekly and you utilize that in the lower time frames. So in this example here, we're on the hourly chart and we have our daily order block here, these 3 consecutives, that's our daily order block. We extend that forward, and using this level we frame what? Longing setups, because we're bullish in this scenario here, right? So we drop down into it here, dig into it a little bit deeper, and then we ultimately frame a nice long setup off of that, and then we trade back down into it here. I'm not going to count this because it's a little bit of a carnival ride here, but ultimately we trade back down into it one more time, slam into that opening, right? We create the swing low, turn away from it, begin the buy program. Lots of buying opportunity in here towards what? Premium relative equal highs up here. That's a gross oversimplification of one example here, but it's very, very powerful, and a whole new world opens up to you if you just simply start from that weekly time frame, derive your bias with that weekly candle rejection right here. Okay, once you have that, you go down to the daily chart, frame out all your levels, and with this little diagram here, we start from the weekly, go down to the daily, and then down to the 1 hour. And then anything below 1 hour is just simply finding your entry. So all of these time frames in here is just finding your key levels, and your highest probable levels are going to come from that daily time frame. Of course, the weekly is very, very nice, but nothing is more important than that daily time frame chart, in my opinion. Okay, so element number 1, higher time frame key level. Element number 2 to a high probability trading setup, market structure. Once again, I can't stress how important this is. And it's not the, basic market structure that you see on, TikTok and whatever else. It's not higher high, lower low, none of that stuff, okay? None of that stuff has any bearing on how these markets actually move. Market structure, we look at it as long-term high, intermittent term high, short-term high, long-term low, intermittent term low, short-term low. And in this diagram here, this chart, we can see an example where we run down, okay, likely into some type of higher time frame PD array, right? Create a swing low here. We have a higher swing low to the left, which is mapped out here. We have a higher swing low to the right of it. This automatically cements this as an intermittent term low. Now wait, give me a second. After this, we drop down into this imbalance here. Do we have a higher swing low to the left? Yes, we do right here. Do we have a higher swing low to the right formed? Yes, we do. Once this swing low here is formed, after this one it's higher than this one. This is now cemented as an intermittent term low, which changes this automatically to a long-term low because we now have an intermittent term low backing this long-term low. So what is this? This is literally a basic depiction of market structure where the markets are just pointing their finger of what direction they're going. And in this case, what do we have? We have bullish market structure. The market's telling us they're going higher. What do we have on the opposing end? Can we frame any type of high probable bearish market structure? Well, all I see to the upper end, I don't know about you, but all I see is relative equal high. So I see this as a target, not bearish market structure. Okay, so we have a long-term low, intermittent term low. From there, we'd expect bullishness to continue. You always, when you're framing out market structure like this, you always start from the hourly chart. Okay, mark out your long-term low, intermittent term lows, then go down to the 15-minute and to the 5. Okay, it's just a matter of flipping through your time frames, and this is another lecture for another time, but all you need to know is you really want to focus on framing your market structure on the hourly chart, okay, and go down to the 15 and 5 if you have to. Market structure is key to being in tune with daily bias. Just like what I was telling you on that last slide there, you always, the first thing you do is you frame your weekly and daily time frame key levels. Once you do that, you're easily able to frame long-term lows. So in this case, we drop down into that higher time frame daily objective right here. We create that swing low, cement the intermittent term low initially, but then as soon as we get this drop down here, it creates a swing low, and then we have a higher swing low to the right. Okay, this now becomes that long-term low framed from what? a daily time frame key level. So this makes the probabilities even higher for bullishness because we already derived our daily bias, but now we also have lower time frame market structure supporting that idea in this direction, and we have the relative equal highs resting above. Market structure is key to being in tune with daily bias. You combine daily and weekly key levels of market structure, it's going to take you a long way, okay? All right, element number 3 to a high probability trading setup, liquidity. I'm sure you guys are all familiar with this. There's a lot of misinformation regarding liquidity nowadays, but ultimately, this here is very, very important. You need to have a very good and precise understanding of this if you ever want to see profitability in these markets. Because if you don't know what the liquidity is, you are the liquidity, okay? Old highs and old lows. It is that simple. Where is liquidity? Well, buy side liquidity, it's going to be above old highs. Sell side liquidity, it's going to be below old lows. It's very, very simple, okay? As soon as you start to overcomplicate it, that's whenever things, get out of hand, you start losing money because you're overcomplicating it, okay? There are multiple types of liquidity. You either have time-based liquidity, or you have previous weekly low, previous daily low, or previous session high/low, and so on and so forth. Time-based liquidity is a whole different topic that I'm going to cover in another video because I can talk here for an hour about it. But all you need to know for now, old highs and old lows, and you're going to really find the high probability liquidity pools above or below previous weekly low, previous daily low, previous session high/low, previous weekly high, and so on. Okay? This is absolutely required to frame a setup. If you don't know where liquidity is, if you don't know how to identify it, you have no setup. Okay, you have no framework, you're gambling. You need to know where the liquidity is, or else you will be hunted as that liquidity and wonder why you keep getting stopped out. Learn liquidity, learn the markets. You combine liquidity with everything else that I'm showing you guys in here, you're going to be making a lot of money, okay? Element number 4 to a high probability trading setup, the PD array matrix. I'm sure you guys have all seen this graphic here before, okay? So this middle line here basically is going to be equilibrium, also known as fair value for larger funds. Okay, above that 50 level of whatever dealing range you're working with is going to be any of these premium arrays that we use and are familiar with. And all these markets is moving from a premium, so let's say premium liquidity void, and then moving to a discount, let's say a discount for value gap. All these markets do is move from a premium to a discount and a discount to a premium. That is it. I don't care what anyone else is saying. This is universal and it is used for all time frames, okay? So don't think it's, just simplified to one time frame, okay? It's universal. It can be used on any time frame. The highest probability shorts that you're going to find, in fact, 95% of them, are going to be found in this premium zone. So the red area, so you find your daily dealing range, high to low. Whatever's in that, above the 50 level here, that your highest probability shorts are going to be derived from there. Can you short at equilibrium a little bit below it? Absolutely, yes, you can. But the highest probability is going to be up here. The highest probability longs, well, guess what? It's going to be in that discount. When a discount is offered to the market, your highest probability longs with proper context and narrative from the other 3 previous slides that I just showed you are going to come from this discount range. Element number 5 to a high probability trading setup, displacement. This is the final piece to an A+ trading setup. Understand that the previous slides that I just overviewed for you guys, you need all of that before you look for displacement. Okay, displacement means nothing without the proper context and narrative, market structure, higher time frame key levels, all that stuff. If you don't have it surrounding the displacement, then it means nothing. But in this example that I have here on the left side of the chart here is you look for the displacement after a key level or liquidity has been reached. In this case, we have a key level in the form of a fair value gap here, and we have liquidity taken here. And following that, we have displacement. So assuming we have all the other elements surrounding us with the liquidity and the fair value gap here, we have previous daily low hovering below here. That's our target. And then we get displacement. That right there, within this displacement leg that's created, high to low, this is where you find your entry. Do we see an entry in here? Yes. These consecutive up close candles, that's going to be your order block. And then we also have a fair value gap right here. That's where you want to focus on shorting. Is this in premium of a range? Well, if you take your fib from this low to high, it's pretty obvious that this is in premium or range. What did I just tell you guys? The highest probability shorts are going to be in a premium. So you'd be shorting this discount for value gap, or sorry, you'd be shorting this premium for value gap, okay? And then you're aiming for this discount previous daily low, okay? PD array matrix. That's what I just overviewed with you guys. All right, element number 6. Do not be mistaken. Just because it's this far down in the list here does not mean it's least important. In fact, it is the most important element when finding a high probability trading setup. Time and price theory. Time is the glue that brings everything together to complete the A+ trading setup. Time should be considered before price. It's not price and then time. It's time and price. When we're talking about time, it's either a kill zone or a macro. Nothing more, nothing less. And in this case, in this example, we're within the kill zone, but also we're within a macro here. Okay, so macros, they create continuations or reversal to a key level of liquidity. Nothing more, nothing less. In this case, what do? The macro begins. Where are we coming from? Here's this old low. Here's this liquidity void that we traded into. Discount. So we're trading into a discount liquidity void, reverting to what? Premium buy side liquidity above here. And when is this all taking place of? What is the time framework in here? Well, in this case, we have 9:50 to 10:10. That is a classic macro in price. Okay, 10 minutes before and 10 minutes after every single hour, there is a macro. Your highest probability macros are going to be within the kill zone. The New York kill zone is simply 8:30 to 11 a.m. Incorporate time, and then you bring in all the other elements that I gave you guys here, and nothing is stopping you in these markets. You will be an absolute monster. Now, before I go on to the next slide, you got to understand that element number 7 and 8, they're just steroids to what we already have here. Elements 1 through 6, that is all you need, I promise you. Anything outside of this video, you do not need other than elements 1 through 6. Okay, you'll never have to watch another video again. Elements 7 and 8 are steroids to the base 1 through 6 we have here. And there's something very, very powerful that can add on to the probabilities of your trade if you know how to incorporate them. So, element number 7 to a high probability trading setup, the weekly/daily profile. Understand that day of week is influential to daily bias. The week of the month is influential to daily bias. The month of the year is influential. Understanding these specific profiles that you'll learn in other videos will sharpen your ability to form narrative. And narrative is absolutely key to trading these markets successfully. Without narrative from the higher time frame, it's just simply no better than gambling or hitting the casino. In this graphic here, what we have is classic buy day. So this here is one example of a daily template, so our daily profile, right? And we look at it and we see we have a New York session bullish rally. Okay, classically we have that lunch consolidation. Going into the PM session kill zone, we run out that consolidation in the form of sell side liquidity that was created in lunch, engineered liquidity, and then we had that classic PM session continuation. So this here is a classic daily profile buy day. Element number 8 to a high probability trading setup. Very, very simple, but also very, very powerful. Seasonal tendency. Tendencies of the market are from a macro perspective. Okay, so we find this from the weekly and daily time frame. All seasonal tendency is the time of the year, price action, and then you incorporate SMT divergence. So, for example, we understand that we have a strong seasonal tendency for our low to be formed around June. Okay, so let's say this year we got that classic June low down into a key level, and then we have an SMT divergence formed, meaning let's say ES had a failure swing, failed to get below a daily low that was formed, and then NASDAQ actually swept that low. And then we have displacement following that. There's the SMT divergence setting the stage for that seasonal tendency. So you're going to want to ride that out until the beginning of fall. And that literally just puts your trading on steroids, and it's honestly an ATM machine. It's not needed, but it adds to the probabilities 1000%. And that will conclude this video here. This is 8 of 8 key elements to a high probability trading setup. If you're ever feeling lost or confused in these markets, go back to this video, study it, look for these elements, and it'll serve you very well. Thank you for watching. If this is your first time, go ahead and subscribe, hit the like button, do whatever you have to do.